Katy Burne from Dow Jones Newswires is here to talk about that particular issue. Basically, what we had was a restructuring of a massive amount, $200 billion almost, of Greek debt a couple of weeks ago, triggered what's known as CDS, credit default swaps, and now we have to figure out how the people who own those instruments, which are a form of insurance against default, are going to get paid, right?
Yeah.
So today what happened? What do we have?
So the way you figure it out is you have an auction where a series of dealers bid for the bonds that are deliverable into the auction, and the auction of the bonds determines what the compensation is to holders of the insurance, effectively.
Right. And what did we come out with in the end?
We came out with a price of 21.5 cents. Which is lower than some people expected.
Right.
Because before the
pretty measly.
Right. Before, well, there are some results that have come out even lower. I mean, Lehman was like 8 cents on the dollar, and Landesbanki, the Icelandic banks, came in even lower than that.
What we're talking about here is the package of bonds that came as one form of compensation for this debt restructuring, which was some new bonds from Greece, 10-year, 30-year bonds.
A warrant.
A warrant, which is a GDP warrant, so the little bit of incremental gain that you get from whatever GDP growth Greece is going to get, and like 15 cents on the dollar worth of these bonds backed by the European Financial Stability Fund, the bailout fund. And packaging all that together, the market is basically telling us that it's all worth about 21 cents in the original dollar that you owned, right?
Well, normally it's like
79-cent haircut, more or less.
Yeah, I mean, the thing is, before the results of the restructuring with private creditors were announced, the bonds were expected to be more like 24 cents on the dollar. So this is really telling, because it's telling you that the bonds are worth even less than they were, say, 8-9 days ago, and it keeps going down, and people keep saying, if Greece doesn't really cut, expenses, then we're going to be looking at another restructuring.
Well, I mean, when you think about what a bankruptcy is for, right, and it's just effectively what debt restructuring is, it's an idea to clean the slate, to make sure that you can be ready to grow again. And as a result, I think often you see when companies or even countries come out of these things, there is actually a pickup in their bond prices because they've had the debt relief they were looking for, and now they can grow. The fact that it's actually falling, those bonds are falling in price from what we thought they were going to be beforehand, is a little bit of a worrying sign. Right,
and some people were saying, this is the result of the auction was for determining the price of the bonds was lower than they expected, but then the auction does what it says on the tin. There was 300 million euros of net open interest to sell the bonds, i.e. people trying to get rid of these for the most part. It just is very telling.
No one wants these things.
Yeah.
Now, the credit default swap market itself is an arena of controversy, right? I mean, there was some concern going into this that it wasn't functioning properly. And what can we say about, say, the restructuring and now how this is performed today?
You had a lot of concern that the credit default swap wouldn't be triggered because we weren't sure whether Greece was going to have to use legal means to force private creditors into the restructuring. Turned out they did. So that worked. Investors are slightly more confident by that because there are going to be presumably similar situations coming up in other sovereigns. But the interesting thing about the auction today is that it's the first example of a CDS auction where the deliverable securities to determine the price of the debt were not the same bonds that the insurance actually referenced.
Usually it's the bonds that you defaulted on.
So here we have a whole new set of Greek bonds that were not the ones that were originally insured, and the EFSF crisis mechanism bonds that we got as part. They weren't deliverable. The warrants weren't deliverable. So the ideal would have been to have the whole package deliverable, the 3 parts, to get your insurance back. This was slightly different.
So it becomes complicated and maybe factors in the price.